What's up, everybody? It's Megan here with the Financially Free Era podcast by SLP Wealth. I am looking forward to chatting with you today about signs that you are doing your student loan repayment wrong. Now, you probably also listen to Travis's side of the podcast, the Student Loan Planner podcast, but in case you don't, I didn't want to not talk about student loans when seems like things are settling a bit. We've gone through a long window of transition, window of time of transition over the past 5 years. So we'll jump into a little bit of that here in a second, just to kind of lay the framework. But I want to talk about signs that you're doing student loan repayment wrong, because these are things I consistently see with existing clients and with some of my past student loan planner clients that are emailing me with questions about their plan now. And so I think this is still relevant, even if you are somewhat up to date, because it's still not something you do every day. So I thought this will be a good topic for us to jump into today. And of course, in financial planning, student loans are a big piece to the financial planning pie. So making sure that we're taking care of our student loans is going to help us make sure we're pouring our energy into the right things when it comes to our financial planning, which is important because that means we're getting to your financial goals faster, more efficiently, cheaper, in the best way possible, right? I will also start. I listened to myself on the last pod episode I did about Roth IRA mistakes, and man, do I sound out of breath. I'm going to just get it out there. I am out of breath when I'm talking more these days because I am 6 months pregnant, and all of my organs are, I guess, consolidating. They're getting closer together, and it really does make me feel like, I don't know. I need to like take a break to breathe every so often when especially when I'm talking to myself. This is kind of challenging to have a whole conversation, 30, 45-minute conversation by myself with no breaks or, pauses. So just wanted to get that out there in case you thought, wow, she kind of sounds like she's in shape and running while she's having this conversation. I wish that was the case. No, it's because I cannot breathe. I'm adjusting to my body changing, and being out of breath when I'm talking a lot is one of those things I'm adjusting to. So, for all the ladies out there who might have gone through this, who are going through this in pregnancy, you're not alone. All right, let's start with just the opening fact that student loans are super confusing, and it's because rules have kept changing. And there's mistakes that people can make that end up costing folks thousands or even years of progress towards loan forgiveness by just not knowing the nuances of what the heck is going on these days, which is extremely unfortunate because you are not a student loan expert, right? And so thank you for seeking out the information, seeking out the knowledge for yourself. I know I'm going to try to make this as kind of entertaining and conversational as possible, so it's not dry, like watching paint dry. Because it's hard to keep up to date. It's hard to know what's relevant to you. And, it just seems like things are changing a lot. But the good news is, if you're an SLP Wealth financial planning client, your advisor is here for you. We're taking a look at your plan on an ongoing basis. Every time y'all chat, you're probably having some kind of conversation about if there's anything we need to adjust with your student loan plan. But if you do have questions in between your meetings, just feel welcome to reach out to your planner. All right, so let's jump into sign number one, that you're doing things wrong with your student loan plan. And that sign is that you haven't checked your IDR plan or your student loan plan since the SAVE changes were more formally announced back over the summer. All right, so over the summer, we were kind of waiting to see what this big, beautiful bill was going to spit out, what was going to happen with the SAVE plan, what was going to happen with forgiveness, really, the income-driven forgiveness timelines for these different repayment plans. There was a lot of things that were kind of pending, and some of those things I think got confirmed, during the summer. And so what happened most recently is folks have been in a SAVE forbearance since about summer of 2024. And this is because they were trying to figure out, okay, what do we do with SAVE? Is SAVE illegal? Can we keep it around? It was not brought about by an executive or sorry, it was not brought about by a legislative process. SAVE was not. It was brought about by an executive order. And that was the issue. Congress was thinking, okay, this might be too generous. It didn't go through the traditional legislative process, which maybe it should have. We need to relook at this. And that's why they paused anybody's payments who was on SAVE and they froze interest. So interest wasn't accruing while we were sitting in that forbearance. So that's good, but the downside was sitting in that SAVE forbearance was not going to count towards any kind of income-driven forgiveness timeline or public service loan forgiveness timeline. So folks who sat there were on pause, basically, like no harm when, and with interest accruing or anything, but also no progress towards a forgiveness timeline, right? So I think we're caught up with kind of where that's at. And then over this past summer, 2025, they made the announcement that, hey, SAVE is going to be taken out. We're going to take it away. And oh yeah, by the way, interest is going to start accruing August 1st. And there was a panic kind of over the summer, I would say, a big panic about, oh shoot, well, interest is going to start accruing. I need to do something. And so around that time, folks were trying to figure out, okay, do I need to switch plans? Do I stay on SAVE even though I don't have a payment? Like, what do I do? And so many folks, and what we were telling folks on the student loan planner side was, hey, if you're working towards loan forgiveness, you probably want to go ahead and get on a plan that's eligible for loan forgiveness or to accrue, qualifying months towards forgiveness now. So that would be on income-based repayment, IBR, or the pay plan for now. The pay plan is supposed to be going away in 2028, but it still exists right now for you to get on, and it's still supposed to accrue credits towards your forgiveness timeline. So that could be an option. And then there were some other folks who thought, okay, well, maybe I'll just stay on SAVE for whatever reason. And there's a couple reasons why maybe that makes sense. Maybe your interest rate is pretty low on SAVE and your plan is not to go towards loan forgiveness. So you're just going to start paying the loan off as you want to, like not really entering a repayment plan, but throwing money towards the loans as time goes on, as you're making money, as you're able. That might be one reason is our interest rate is fine, it's decent, it's better than we can get if we went to go refinance, and we don't really want to be committed to a specific repayment plan or payment amount. So we're just kind of making payments as we can. That's one maybe good reason to hang out on SAVE. Another would be just out of necessity, where we are not able to afford what that new income-driven payment would look like, whether that be on pay or IBR. It does not fit in the budget right now, but we're tackling what we need to make it fit in the budget, right? Reducing our spending, maybe paying off other debts first, kind of taking the SAVE forbearance that we still have, taking advantage of it to wrap up some of our other stuff, tie up loose ends. That might be another reason. And then a final reason that somebody might be on the SAVE plan right now is because they're not eligible for any other income-driven plan currently. And that's kind of a conundrum that folks are finding themselves in that have higher income now than they used to. They still want to pursue loan forgiveness or because they're really close. Like let's say they're pursuing PSLF, they've got a couple more years to go, but they just can't get on an income-driven plan right now because their income is too high. And that could be because maybe they filed jointly for the most recently filed tax return. So they're taking into account joint income, which is going to push us over that payment cap that's allowed for being eligible for the pay plan or the IBR plan currently. Or it's just legitimately you're making more money. Now, what's going to happen summer of 2026 is IBR is going to basically allow you on the plan, even if you don't have that partial financial hardship requirement. And that just means that if your payment calculation is higher than what the standard 10-year payment calculation would be, they'll give you the standard 10-year payment calculation. They won't deny you. But we don't think that's going to be implemented. At least we can't tell that it's been implemented yet. We don't think it'll be implemented until summer of next year. So those are kind of the three little buckets that you might be sitting in if you're still hanging out on SAVE and where it might be an okay decision to hang out there, right? But otherwise, if you are someone who's pursuing PSLF, pursuing income-driven forgiveness, we can reasonably make the payments if we were to switch to a different plan. Let's get going on it because we're missing out on time that's working towards your overall forgiveness threshold. So it's better to go ahead and get switched over now versus later. Yes, it's going to stink that we have a payment that's kicking back in. That's the reality, though. We knew this time was coming. We knew we'd have to start making payments again. So make sure to go and confirm, okay, which plan do I need to switch to? And you can apply for that plan on the studentaid.gov website. So studentaid.gov, make sure you have access to that. Apply for the best plan for you and start working towards that timeline if we're going towards loan forgiveness. All right, sign number 2 that you're doing things wrong when it comes to your student loan plan is that you're not doing tax planning. And this is primarily, almost exclusively for folks who are going towards loan forgiveness again. And I promise I'm going to get to things that are not related to forgiveness soon. So if you're someone who's paying your loans off, I'm going to get there. Maybe fast forward a little bit. But if you're not doing tax planning when you're on an income-driven plan, I think that's a mistake because tax planning, in general, is something that you need to do proactively. So what that means is, right now we're in 2025. All of the taxable events and all of the things that could generate tax deductions or credits or things that reduce your taxes, like we have to be doing in the tax year for the most part, right? Not everything, but for the most part, all of those things have to occur in the 2025 tax year, not when you're giving all your documents to your CPA before April of the following year. CPAs, tax planners, like their job, they have a couple jobs. So if you're working with just a tax prep office or someone who just does tax filings, they're not really doing planning with you. They're just taking all of the documents that you're giving them, they're plugging it into their tax software, making sure that you're not missing out on credits or deductions or things that you're rightfully eligible for. And then they're submitting it through to the IRS, getting it processed, getting it submitted. There's not planning that they're doing because the year is already over. There's no planning to be done at this point. The year's already done. Okay. So tax planning, when you're working with a comprehensive tax professional who does both maybe the prep, the filing, and tax planning, they're going to be reaching out to you during the tax year. So for example, our tax team reaches out over the summer to do summer tax planning meetings. And that's a great point in time. It's midway through the year to run some tax projections, see if we're over or under on how much we're estimated to pay in taxes between that point and the end of the year, make adjustments if we need to, and then also talk through some proactive things you could do between middle of the year and end of the year to reduce your tax liability, like making sure we're maxing out your 401k. We are contributing to your HSA if we have access. We're doing things to reduce our adjusted gross income. Then also, what we do at SLP Wealth, since our tax planning is integrated with our financial planning, is we're also trying to figure out, okay, are we going to be filing jointly or separately for student loan purposes? Because that's going to have some implications on things that we do in this tax year, 2025, even though we're filing the return next year, right? So for example, if we are someone who's married and we want to keep the student loan payment off of just our own income versus our income and our spouse's income, filing separately is going to be something we want to consider and talk through, like the crossover point for, like how much are we missing out on in tax benefits by filing separately, but how much are we gaining in what the student loan payment would be compared to what the joint payment would be. So that's what we call the crossover point, and that's what helps us determine, like, okay, yes, married filing separate totally makes sense, or hang on, let's pause, married filing jointly might at the end of the day save us more money because it doesn't save us enough if we're filing separately on our student loan payments. We do some of that planning as well within our practice, if you're working with us with your financial planner. Why that's also important is because filing separately touches other areas of your finances. So if you remember in the Roth IRA episode I did last week, if you file taxes separately, you basically cannot contribute to a Roth IRA directly. And we see this done wrong a lot, where we decide, let's say you're not working with us for taxes, you're working with H&R Block, or you're just doing your own taxes. You have a conversation with your planner, or you decide you're going to be filing separately for student loan purposes in, April of next year for 2025. But you already made direct contributions to your Roth IRA because you were under the income thresholds, you were able to, but you're then deciding filing separately. Well, oopsie, we've already made a direct contribution to your Roth IRA, which is going to be a problem. So we're going to have to fix that. We're going to have to basically, before we file taxes, we're going to have to amend that by reclassifying that contribution as a IRA, non-deductible IRA contribution, and then converting it into the Roth. And now that we're after the 2025 tax year, this is going to be reported on 2 different tax years, tax documents, which makes things a little more complicated to reconcile over time, especially if you're doing taxes on your own. It can be done, but it's a little more tricky because it's 2 different tax years. We have to reference both tax years to true up what happened. Um, so that's an example of, again, like something that we do when it comes to filing taxes, that it would have been better to be more proactive and know that that was the plan during the tax year. So we could have made decisions that was going to simplify the filing process come when we actually have to file the returns. So tax planning, all that to say is tax planning is a proactive thing that you have to do before you're filing your taxes. Again, like when we're filing taxes, it's too late to basically do tax planning because the year is already done. We have already made the money that we made. We've already made the contributions that we were going to make. There are certain exceptions for business owners on things that you could do later, like after the calendar year, before the filing of the return. But generally, you want to just make sure you're getting your ducks in a row for what you want to do tax-wise that affect your student loan plan and that affect other areas of your financial plan. You want to do that early and on an ongoing basis. So, talk to a tax pro who understands student loan strategy. If you don't find a tax pro that understands student loan strategy, make sure you've got the right people in your corner, either a financial planner, like those of us at SLP Wealth that understand student loan repayment and how that kind of ties into both your tax plan and your financial plan. You could work with a consultant, a student loan consultant that can help you kind of advise your own tax person on what to do come tax time. But you just want to make sure with this piece of your plan, since it can be such a big piece of your finances, you just want to make sure that you've got the right people in your corner that are giving you good advice on what to do, because it's going to save you time, save you money, and then save you some headache later if we did something wrong. All right, sign number 3 that you're doing your student loan repayment wrong would be that you are not tracking your PSLF payments, and then soon not tracking your income-driven repayment payments. So right now, the PSLF payment tracker is alive and well on the studentaid.gov website. This is how you can get a feel for exactly where you sit when it comes to your payments towards that 120 payment threshold if you're pursuing PSLF. I love this tracker. It has its flaws in the sense of it takes a long time for it to get updated sometimes. But once it is updated, you can see line by line, like if you have multiple loans, you'll see every loan itemized. You'll see every month itemized, what month it's giving you credit for. There's a couple statuses. There's qualified, which means you've already submitted a PSLF form and they have confirmed that, yep, you worked here or worked at an eligible employer. We have qualified this payment towards PSLF. So you can check that off as counting towards the 120. That's one status. Another status is needs employment certification. That is a payment that's been made that should count as long as you have a PSLF form on file for that employment timeline. You'll start to see these accrue as time goes on, because when you submit a PSLF form, it's not going to continue to qualify those payments going into the future. Why? Because they don't know if you're still going to be there tomorrow. You could quit tomorrow. They're not going to qualify those payments until somebody signs off on that form that says, hey, I was still there. So that's why we recommend submitting a PSLF form once a year just to keep a pulse on where your payment counts are, make sure we're scooping up those needs PSLF form, the needs certification ones that they're counting up, they're flipping those over into qualified over time. And then the third status is ineligible. This is one that you probably want to pay attention to make sure is accurate. Ineligible might be for periods of forbearance, like where you were not paying, periods when you were in a grace period, so the 6 months post graduation, that is not going to count towards PSLF. Periods of time in school. So if you were in school deferment, those periods of time should not be counting. Or ineligible because we made a payment, but we don't have a PSLF form on file, or we do, but the employer was not eligible. So those are the three statuses. And if there's anything wrong with those statuses, so let's say we've got a lot of statuses that say needs employment certification. Well, fine. We could simply just submit a new PSLF form for that employment time period. Make sure it's done through that digital PSLF help tool on the studentaid.gov website. Make sure somebody at that employment space signs off on it, and that will update your payment count. Perfect. Easy peasy. That will take care of those. But if it's ineligible and you feel like that is wrong, first line of defense is submitting another PSLF form for that time period. If you really think it's just not correct, maybe they misread your prior form, get it resubmitted, see if that fixes it. If not, there's a PSLF reconsideration process where you can simply just type in PSLF reconsideration on the studentaid.gov website. And that's where you can respond to a approved, like once they've processed a PSLF application, you can respond saying that you think your payments are not counted correctly and identify which months that are wrong and why you think they're wrong. And you can upload like the PSLF form that you submitted that shows that eligible employment type or some other supporting documentation. There is also what's called the PSLF buyback. This is another thing that you could potentially take advantage of. You can only use this though if you already have 120 months of employment. And if you added up all your qualifying payments and all of your ineligible payments, let's say they're ineligible because you were in forbearance, then if you add those all up and they equal 120 payments or more, you can apply for PSLF buyback. And PSLF buyback, what that looks like is you're saying, hey, I've submitted my PSLF forms already. I have eligible employment for these 120 months. There are some months that I was in forbearance though, and I would like to offer to pay for those months. That's what PSLF buyback is. We are purchasing the months that we were in forbearance that we didn't make payments for. And they go back, if it's from prior tax years, they could be asking for tax documents for those tax years to calculate what the payment should have been during that time. And they'll come back to you with a lump sum number for you to pay. And that lump sum number would get you to 120 payments. And so that would tackle you achieving PSLF. So that program is working. It is just moving at a snail's pace. It is going very slow. Their processing on that is taking a long time. It's probably because there's a lot of math involved. They've got to do the math on what your payments should have been, what payment plan you could have or should have been on at the time, and then give that to you in a form of here's the lump sum to pay, here's how you can pay. So not giving them any excuses. This should be a process that they've gotten nailed down by now, but it is taking some time. So it is something that you can entertain though if you're already at 120 months. So definitely take a look at that. But know where you stand when it comes to your PSLF payment tracking, because the PSLF program is a great program. It is flawed in a lot of different ways. It takes a lot of time for things to get processed, but it will be worth the effort when you get across that finish line. We've seen many, many, many people get across that finish line. It just takes time. It just takes attention. It takes probably multiple efforts to try to get things moved through. But once you're done, you are done. And it's tax-free loan forgiveness. So, sign number 4 that you are doing student loan repayment wrong is you are still waiting in limbo on your IDR application if you applied for a different income driven repayment plan before May 2025. All right, so what does this mean? There have been a lot of folks that have tried to get off of the save forbearance into a different income driven plan, but maybe they applied last year or they applied at the beginning of 2025 before May 2025. With servicers like Mohila in particular, there had been a lot of system updates earlier in 2025 that could have affected them being able to process your application. And actually, there were site wide issues when it came to studentaid.gov because there used to be save on the income driven applications that you could choose. We know that plan is no longer in existence. So if you had applied for save back in the day, we need to submit a new application. But then there was another option. So maybe you didn't apply for save, but you chose where it said, put me on the lowest payment possible, the lowest monthly payment possible. Well, back then, before the BBB came out and they said, hey, save is done, the lowest possible payment probably was going to be save. So technically, you chose save without choosing save, if that makes sense. And so applications that requested either save or the lowest payment possible need to be resubmitted. And a trigger or like an idea of, could that have been me? Definitely before May 2025. If you submitted before May 2025, you probably need to resubmit again. If you submitted, I'd say kind of the latest would be, when did BBB get approved? So let's say in June, July. If you submitted before June or July and you're still waiting on your income driven application to get approved, I would go ahead and resubmit. Basically, if you resubmit an income driven application online, it should cancel out the old one that you submitted and process with what you're submitting now. And you can go ahead and apply for IBR, ICR, or pay at this point to get off of save. Otherwise, you're going to be sitting in the save forbearance for longer, which we know is not going to help you if you're pursuing loan forgiveness. So I would do that, reapply. Now, what if you're somebody who, again, you have new tax documents on file since you submitted originally? Now the payment's going to be higher. Now, that is unfortunate. Reach out to your financial planner, reach out to your student loan consultant, see if there's anything you can do there with where your situation lies right now. Like, because there are other options. You don't have to submit with the tax return. You can submit with current pay stubs or current income if that helps. There's a couple different ways you can go about it, but there does need to be some thought on what gets submitted if maybe the income information that you're submitting now is drastically different than what you did submit previously. So I would reach out to a qualified professional to chat about what your options are. But either way, you probably need to resubmit if you're somebody who's still sitting in limbo and you applied before summer of 2025. All right. Sign number 5 that you are doing student loan repayment wrong is either you refinanced too soon or too late. So, refinancing. Refinancing is privatizing your loan or restructuring your existing private loan with a new loan that's in the private sector with a private bank, private company. And the goal is to get a lower interest rate. And you can rearrange your terms as well. You can choose your term when you go and refinance. So refinancing, it's not a bad thing to do, but it is not the thing to do if you're planning on going towards PSLF or loan forgiveness, or you need the flexibility of an income-driven plan. So if you're someone who keeps getting mailers about 5% interest rates, 4% interest rates, refinancing options, like they could be tempting because you're looking at the interest rate, but compared to what maybe you have in the federal system. But if you're someone who's going towards PSLF, do not get tempted because you are not going to be able to get any kind of loan forgiveness if you go and refinance. If you're someone who may need to rely on the income-driven forgiveness, then don't get tempted or at least talk to somebody who can walk you through the pros and cons and what the numbers actually look like to compare what continuing towards the forgiveness route looks like, is compared to going and refinancing. Because once you refinance, once you sign on that line to privatize the loans, there is no coming back. We cannot move those loans back into the federal system, unfortunately. So we just want to make sure that we feel super confident about that decision before going and doing it. Again, not that it's a bad idea, it could be a great idea. So if you're somebody who is sitting in the save forbearance or is looking at the forgiveness path and they're thinking, okay, well, this doesn't make sense anymore. My income is a lot higher, my balance is lower. Payoff is really the way I need to be going. Refinancing can be a great option as long as you have good credit and we can get an interest rate that's lower than what you currently have. Federal interest rates are not horrible. They're definitely not horrendous. They could be between, well, if you've got some older loans, they could be as low as like 2 or 3%. But more recently, your average is probably 6 or 7%, which is not horrible, right? But if we can get a couple percentages shaved off with refinancing and the plan is to pay the loan off, that could be a great thing to do. And so you can shop refinancing rates without committing. You could do what's called a pre-qualified interest rate check. That's where you put in some basic information about yourself, like your profession, your income, your expenses, like your mortgage or your rent, for example, and then the balance that you've got. They give you a pre-qualified interest rate, and that's what they think that you would be approved for if you formally went through, ran credit, and applied. And so you can do that with a couple different companies, get a couple different pre-qualified interest rates to see who might offer the lowest. And if the lowest offered is lower than what your existing interest rate is, go for it. That might be a good thing to do. Now, some other cautionary things to talk about when it comes to refinancing. Again, it's a permanent decision. So that's number one. Make sure you feel super confident with leaving the federal system if we're doing that. But also, we do leave some more generous repayment and like forbearance options, I would say. So payment pauses. There are some of those within private loans, but they're not as generous as you might see in the federal side. So if your income is really variable, or you're kind of going through a job transition, or you just don't feel as secure in your finances right now, like let's say your emergency savings doesn't make you feel warm and fluffy, then you probably should address that first before going and refinancing. This is where emergency savings is extremely important because even if you're hurt, you're injured, you're not able to work, or you get laid off, or you're between jobs, this is a bill that you're going to have to pay still. And yes, private loan carriers, they still have hardship forbearances, but if you can avoid it, or if you run out of time, like if you needed more time than what they offer, emergency savings is going to be your first line of defense against accruing other debt, like credit card debt, or having this negatively affect your credit. So make sure emergency savings is in a good place. And make sure you feel confident and comfortable with the payment. So, a lot of times when it comes to refinancing, I tell folks, hey, we're walking away from some flexibility. This is the right move for your particular situation. We're paying the loans off, but let's build in some flexibility. And what I mean by that is you can choose your term. So, that means you go through this process, you get a couple options on what loan you can commit to. So you can commit to like a 5-year term, a 10-year term, 15, could be as long as a 20-year term. And that just gives you, basically it takes the balance and it amortizes your payments to where you'd pay principal and interest off within either that 5, 10, 15, or 20-year timeline. The longer timeline, the 20-year timeline, is of course going to have the lowest payment, but will be more expensive because we're dragging the payments out over time. So we're paying more interest over time. Interest rate might be a little higher than what it is on the 5 or 10-year term. 20-year term, though, will give us the lowest payment floor, gives us the most payment flexibility. So I like to talk through that. Like if we have a goal to pay these loans off in 5 years or 10 years, maybe let's choose the 15-year term just to give us a little bit an insurance policy, in a way. just to give us a little insurance on making sure that those payments feel super comfortable and we can pay extra if and when we can to really shoot for that 5 or 10-year timeline. But that way we have a lower payment floor locked in, like where we're not committed to having to pay the loan off in 5 years if things get tight. Our stretch goal is paying it fast enough to be done in 5 years or 10 years, and we can do that. There's no prepayment penalties with these refinancing companies. But that's the kind of flexibility I'm talking about that you can build in for a private refinance, which can be really helpful. So if you're someone who is looking to pay the loans off, you feel comfortable with your emergency savings, you feel comfortable leaving the federal system, go ahead and look at refinancing. Go ahead and look at a couple different companies, what they're offering on the studentloanplanner.com website. We have a page that compares all the different reputable companies out there that are offering cashback bonuses as well. So that could be something you use to shop the different rates. And then, yeah, don't refinance though if you don't need to, or if you're going towards loan forgiveness. That's all I'll say there. All right. Sign number 6, that you're doing student loan repayment wrong. You are not staying informed. Maybe that's the way I'll put it. You're not staying informed. You're not making sure your contact information is updated with studentaid.gov or with your loan servicer. And I'm going to put in a plug. I think you should be subscribed to the Student Loan Planner newsletter. So go to studentloanplanner.com, subscribe to the newsletter. Travis sends out a newsletter every Thursday. Sometimes it's me that's writing it when he's out. But both of those things are going to keep you informed. And yes, is it overwhelming to get notices about things? And sometimes does the student aid system send you generic stuff that's not even relevant to you? Yeah, but it's better to be informed than to miss something, in my opinion. And our newsletter, I think, does a good job of helping you distinguish, like, what should I be paying attention to and what is okay to ignore. What's just like a mass notice that I don't really have to pay too much attention to. So that I think you need to be doing to be proactive with your student loan repayment plan. There's too much at stake, right? It's a big piece of your financial puzzle. We want to make sure that we're not missing out on things or deadlines or things that happen. Things have been changing the student loan system so fast. We stay up to date on it and we let folks know what the heck is going on and what to pay attention to, and that can help guide you when it comes to your own student loan repayment journey. So stay plugged in to both the DOE announcements, so what comes from studentaid.gov, to your servicer announcements or details. Work with a pro that tracks these things for you. So, work with SLP Wealth on the financial planning side if you just need student loan advice. Really just want to work with somebody in just that student loan consultant capacity, then Student Loan Planner is a great place to go. All right. I think that covers things. Those are the 6 like big red flags I see, the 6 things that really make me think, okay, we need to address this right now. So hopefully you're not doing any of these signs, or none of these signs were relevant to you. But if they are, reach out. We can help you. This is something that is our bread and butter. We can help navigate this as it relates to the student loans themselves, but also in the broader sense when it comes to your financial plan. And having a student loan repayment plan, this is not about being perfect. It's about knowing the rules. It's about knowing the game, that we're having to play, and making sure that we're just not giving up time or money or progress towards what we need to be doing with our loans. So do a quick self-check of these 6 signs. Make sure you're not falling into any of these buckets. And if you're unsure, make sure you're reaching out to somebody who can be sure, who can help you be sure in what you're doing, so you're not leaving things on the table. But thanks for hanging out with me today. And I think I got through this relatively fine without being too out of breath. Hopefully it wasn't distracting if I was huffing and puffing, But I hope you have a lovely weekend coming up, and I will catch you on the next one.
Are you ready to unlock financial freedom faster with SLP Wealth? Get high-quality, affordable, student-loan-aware financial planning and get the best deal for it anywhere that you're going to find working with your own dedicated SLP Wealth financial planner that is able to give you the best integrated advice across financial planning, investments, and tax, along with all the student loan hacks that you need and that impact all other areas of your financial planning. The deal you're going to find here is special just for podcast listeners. If you go to promo.slpwealth.com, you can sign up with a great discount off your first month. That's promo.slpwealth.com.